And good evening. You've got More Than Money. You've got Gene Dickinson, your host, your personal financial advisor. Part two of a very special event. It's very special for me. I'm hopeful it's very special for our live studio audience as well. We've got tons of wonderful folks here, and then there's other folks too, but tons of wonderful folks and some very, very interesting questions. We're airing all of their questions. You could have been here. You got the invite. That's your choice. We all make our choices. Bottom line is that often we encourage you to send us your questions to my email, gene@askmtm.com. We have a tremendous team of advisors that answer all those questions back to you. They happen to be here today, as a matter of fact. And when we end this segment, I'm asking Javi, give me a minute or two. I'll bring everybody up so that they can see them. Most of these folks know at least one or two of our advisors. We'll see the whole team, and that'll be fantastic as well. And you have maybe had your question asked and answered by them. We answer all of them. Absolutely free, no cost, no obligation. It's a service that we are happy to supply. And gosh, 6 seasons in, somewhere around something in excess of 4,000 shows I've done, radio and television combined, 6,000 or 7,000 hours on air. And I have to admit, I look every minute of it. Bottom line is that that's not the important part. The 780 years of experience is not the important part. You are. You are. Tonight, you're going to eavesdrop. But everyone that's here with us, everyone that watches at home, you're the reason that we are, without a doubt, and we boldly claim to be the most relevant financial show on television today. We don't argue that with anyone because we are absolutely confident that is true. Doesn't matter what station, 24/7, 365, we're the most relevant because we focus on you. And tonight, you're going to eavesdrop as we focus on these wonderful people. Welcome to More Than Money. Oh, please. Oh, please. Silliness. You may have noticed, particularly since you've been here for almost a week now, it's the illusion. What are you going to do? You may have noticed that we take our work, our service to our clients and to our audience very seriously. We don't take ourselves very seriously. I think that's a secret sauce that sets us apart. And I think for most of you in this room, that may actually have been one of the reasons that you were attracted to even consider working or attending or asking questions of someone, because there's a lot more to life than money. We didn't pick the title arbitrarily. More Than Money is it's a lifestyle, it's a philosophy, it's a way that we approach all things. And before we started our first segment, a young lady that I met just briefly had mentioned that struggling. Food on the table, healthy, happy, warm, modest house, struggling, but happy. I'm not sure I would call that struggling. There's a lot of folks that have tons of money piled up in the corners, and they're not happy. So happy, healthy 100. Happy's right in the title of our club. So let's address as many of these questions as I can and see if we can help. Would it be beneficial if I combined my 401k with other accounts that I have? Okay. What phrase? It depends. We've trained you up on that. Did that kind of spring to mind? The answer is sure. It depends. It depends on the accounts, first of all. Can you combine a 401k with an IRA? Yes. Can you combine a standard 401k with a Roth IRA? No. Can you combine a 401k with a bank account? No. So there's lots of mechanical issues that you've got to be very, very cautious about. And there are pros and cons to combining. Certainly simplicity is one of the pros for most of us as we mature. And I'm still waiting, but as we mature, my wife assures me, as we mature, we want to simplify. We want things to be cleaner. We want things to be less stuff, easier, fewer moving parts. And so if we can combine accounts, it's very useful. We have often, our team often bumps into folks who come in with 2 or 3, rare, but often, sometimes 4 401k accounts. Could they combine all of those into one? Absolutely, absolutely. There are folks now that are working well beyond age 70 and well beyond RMD age of 73. So if you're working beyond RMD age and you have a 401k, you might want to keep it, because 401ks are not subject to RMDs as long as you're contributing. So for someone, particularly someone who is maybe the queen of strategy, who would say, hey, if you got a 401k that you don't have to take money from, and you have an IRA that you do have to take money from, why don't we push your IRA into your 401k, and now you have no RMDs? That's a pretty cool strategy in the right set of circumstances. So combining IRAs, absolutely. Often we find folks who have lost their spouse, they still have the spouse's IRA and the spouse's name. Can they combine that in their own IRA? Yes. Yes, they can. So lots of pros and cons, lots of mechanics, but bottom line is that often it is the case that you can combine accounts and make your life a bit simpler. Excellent. I'm putting my home up for sale at the end of the year. Next tax season, I will have to pay. Okay? Taxes on anything that's above my cost basis. All right, let's talk about that for a moment. When this individual says my home, I'm assuming it's where they live. Is that how you would read that? Yes, okay. So in a residence scenario, your cost basis is important, no question about it. I'm going to use a simple set of numbers. I bought the home for 100, I'm selling it for 400. We okay with that? Yeah. Excellent. I've had it for 35 years. And along the way, I've added a roof, got to replace a roof. Heating system, that was expensive. Remember when the HVAC went out, I added that. The kitchen renovation, one of my favorites. I add all of that up and it looks like I've put about $100,000 more in different improvements over the years. So now my cost basis is 200, my sale price is 400, my capital gain, at least gross capital gain, is $200,000. How much tax will that individual face on the $200,000? Roughly. Roughly zero. Yes, as an individual, you may sell your home for a profit, not a sale price, a profit above and beyond your cost basis of $250,000, and you pay no tax. A married couple can sell a home for a profit, $500,000, and pay no tax. Very, very useful. So from the standpoint of cost basis, people go, it's my residence, I'm not worried, I don't need cost basis. You might very well need it. Because in my scenario, my demonstration, 100 is what I paid. If I paid no attention to my cost basis and I sell it for 400, I've got 300 of profit. I only get 250 free. I have to pay tax when I should not have paid even a dime. So that kind of makes sense. As a strategy standpoint, and again, I keep referencing the queen of strategy. She is always thoughtful. My co-host on our Saturday morning radio show, Alyssa Young, is with us. And if you are very smart in the meet and greet, you'll spend time with her because she knows stuff. And one of the things that she would counsel you on is that we often meet folks who have 2 homes. Not unusual at all. They have their residence and they have a vacation home. Might be at the shore, might be on a lake, it might be. And one of those homes is not their residence, and they're going to end up paying a lot of taxes. Or not. Or not. If we think carefully through this, and if it's possible, it's mechanically, it's not for everybody, but it works. When it works well, it works for you. Bottom line is that you can sell your primary residence, just as we just described. I've sold it for 400, I had 200 in it, and now I have a $200,000 profit, I pay 0. And if you wished, you could then move to your Vacation home. You need to stay there. Anybody know how long you have to be there? 2 years. 2 years in a day. The IRS, nasty. Bottom line is 2 years and sell it. And if the profit, again, is under $250, you pay zero. So it is very possible in a 2-year period of time to sell 2 homes for an exceptionally large profit and pay zero. Isn't that lovely? By the way, it only works if you know about that in advance. If you've heard the phrase, it is better to ask forgiveness than permission, not in income taxes, you had better check with your advisor. Hey, I'm thinking about. Good. Thinking about is correctable. I've done this. How do I fix it? This is where our diplomatic skills are tested, because you want to go, why didn't you just ask? So asking permission rather than forgiveness will save you a lot of money on your taxes. Makes sense. Very good. Gene, can you explain the mechanics of a second opinion meeting? How long does it typically go? What level of information or documents would be required in order to make it proactive? Second opinion meeting, you may have heard that phrase in our discussions on air multiple times. More Than Money and MTM Advisors offers free second opinion meetings to folks who request it. I would love to tell you we're the only ones. We're not. We're not. Our show is nationwide, border to border, and coast to coast. And there are tons of fantastic financial advisors out there. Absolutely tons. There are some boneheads, yes, that do things they should not. True of any profession. We get that. But there are tons of high-quality advisors who offer the exact same service, a free second opinion meeting, where you get to meet the advisor, ask any questions that you want, get as much information as you wish, and if it seems like a good relationship, maybe you engage the financial advisor. And if the financial advisor feels like it's a good relationship, he or she might invite you to become a client or not. It's a dual directional experience. Does that make sense? Am I explaining that well enough? Good. So from a dual directional experience, you should come with as much information as you need, as much documents as you need, not that we need, as you need, to be able to explain your concerns, demonstrate the concerns, and get the answers that will help you. It's just that simple. If I took a quick survey of the team in the back of what percentage of prospective clients come with absolutely no documentation whatsoever, what would you guess? 1%. Zero. Come with nothing. How many come with everything? Zero as well. Zero as well. No one brings everything. Not to the first meeting, of course. But bottom line is that no one, number one, they may not know what to bring everything. Number two, there's always, I should have brought that. I was going to look up my Social Security benefit statement. I was going to print that off. I forgot that. That's perfectly fine. There's no pressure. There's no anxiety. There's no stress. It is simply an opportunity to have an hour with, and it's approximately an hour typically, hour and a half at most, where you're just exchanging ideas. Here's where we are. Is there a better way? On rare occasion, sadly very rare, the answer is you're doing great. And how wonderful would it be to walk out getting a second opinion saying you're doing great? In most cases, it's not sure why they're doing that. I'm not sure that's in your best interest. And as fiduciaries, it's our job to do what's in your best interest. So we share as much intel as we possibly can in a short period of time. A lot of folks have over the years, and a lot of our competitors, financial advisors that I meet at different conferences will say, why are you giving it away? Why do you not simply charge a very substantial fee for that consultation? It's very, very simple. If I charge you a fee, you're my client. Done. No ifs, ands, or buts. And the SEC and FINRA and all the state regulatory authorities consider that whatever I have said to you is to a client. and I am held to a very, very high standard. I don't want to be held to that high standard until I believe that you should be a client, that you fit us, that you're going to be here 20 years, or in my case, 30 years. Or if you're with John, you're going to be here 60 years. The kid's in great shape. He's going to hang around a long time. So bottom line for us is it's an opportunity for two very intelligent people, you folks, us, to get together and determine where is the value, because that's what it's all about, is adding value. I hope that makes sense. Okay. See what we got. Oh, very nice. What should a married couple in their early 40s with no children consider when choosing, very good, between an IRA and a Roth IRA? Everyone know the difference between the two? I think everybody pretty much does. IRA standard, you get a deduction going in, tax sheltered until you take it out, tax when you take it out. Roth IRA, no deduction, no tax while you're waiting, no tax when you take it out. Which is better? Sure sounds that way. It sounds like the Roth would be better. The reality is it's, the old oil filter commercial. Fram, you can pay me now, you can pay me later. Yet, reality, if, remember from part one, remember our Roth IRA our calculation for the young person, where we gave them $20,000 early and it turned into $600,000? So the $20,000 we got no deduction on. And let's assume that we're in the 15% bracket. That means we gave up, intentionally gave up, $3,000. In exchange for, I think you're all way ahead of me, saving 15% on $600,000. And I'm not a math whiz. Actually, I am. But if I'm claiming to not be a math whiz, I would go, oh, what could that possibly be? I wouldn't pretend I would not know that it's $90,000. So would you rather pay 3 or 90? It's a pretty straightforward question. Now, for lots of folks, it's become very confusing because sadly, a lot of financial advisors make it confusing. They're in their 40s. They've got lots of time, tons and tons of time in order to go from putting money in to taking money out. For goodness sakes, Triple H, they might be 60 years before they take that money out. Compounded tax-free for all those years, it gives me goosebumps to think about it. It pisses the IRS off, but I don't really care. I don't really care. They're going to find all kinds of waste in the IRS anyway, so off they go. Bottom line is, we don't need to give them $1 more than we are legally obligated. I am a big fan of paying tax. I am a big fan. It is the price we pay for living in the greatest country that's ever existed on the face of this earth. Absolutely, but only my legal amount. If I want to make extra, I'll make it to my church. I'll make it to somebody else that I care about. So bottom line for us, fantastic opportunity. In the 40s, in your 50s, consider it as well. And if you're in a 401k that offers both standard and a Roth, you might consider breaking it into pieces. That could work as well. Outstanding. Okay. I'm putting I got that one. Thank you. I'm 69. Should I take my Social Security now or when I'm 70? Does anybody know what the difference would be? Let's assume that at 69 the benefit is $3,000 a month. Does anybody have a rough idea of what the benefit would be at 70? Yes, exactly. It's an 8% bump and cost of living, but let's use 10%. Easy math, all right? So you go from 3,000 to 3,300. So take it at 69 now at 3,000 or wait a year and get 3,300. Which would you do? Bad answer. I have been training you for 2 whole shows. There's only one answer that makes any sense, and that's it depends. It depends. It absolutely depends. Is it likely that that $300 a month is going to be the tipping point between being able to retire and not? The answer is not likely, but it could be. It absolutely could be. Is it likely that this person is saying, I'm going to take it now or later, but I'm already retired? That's likely. Sure, these are all likely, but we can't decide on likely. We can't decide on probabilities. We have to decide on the realities, which is why every single financial advisory client that works with a trusted, experienced financial advisor is treated individually. The companies, and there are a number of them, and some of them are huge, where they interview you and you get dropped into one of 5 pots. And you will be invested along with thousands, hundreds of thousands of other folks, very different than you, but you have to be in the same pot because it makes it very simple for them. It reduces their work. It reduces their need to make adjustments and customize. But trusted financial advisors don't do that. They look at your individual situation. So 69, it doesn't seem like a big difference, but it's 8%, maybe 10% with a cost of living adjustment. It's got to be a personal decision. And I heard a gentleman say up front quite accurately, so I would have taken that as a partial credit answer, when he needs it. If he's 69 and needs to retire now, take it. Don't worry a thing about what might have been. Hopefully that makes sense as well. Can you explain the new Bitcoin exchange-traded fund that provides downside protection? No, I can't. Tough. It's a frickin' mystery. Am I allowed to say frickin' mystery? Camera people are going, say whatever you want, buddy. I get paid the same amount whether you get tossed off by the FCC or not. Actually, I know quite a bit about this. Let's start with Bitcoin, cryptocurrency in general. Everyone has their own opinion. God bless you. I have my own opinion. Of course, I will be right. You will be wrong. There's nothing behind any of it. It is air. So if you buy shares in Apple stock, you're buying shares in the real estate they own, the intellectual capital that they have, the cash flow that they generate. I understand that. If you buy a piece of real estate, you receive tax deductions, you might receive rental. I understand that. You buy Bitcoin, Ethereum, Dogecoin. Is that what it's called? Yeah, true. But at any rate, there are now, I've lost track, is it more than 10,000 cryptocurrencies? More than 10,000. So we've heard of Bitcoin and all that kind of good stuff. It's all the same. Electrons. Nothing behind it. So if you are interested, bless you, there are folks who are wildly successful at mining Bitcoin, and they have made a fair amount of money, at least on paper, or at least in electrons, so to speak. Could it go to zero? Sure. What would stop it from going to zero? There's no end value. It's like saying I'm going to foreclose on your house because it's gone down in value. Well, I paid $400, and you're right, it's $340. It's still value, so it's not going to go to zero. That doesn't make sense. So bottom line is there are lots of folks who are going, crypto, you got to buy crypto. And there are interesting permutations that have evolved, including a company that now provides downside protection against losses in Bitcoin. Using options, they will assure you that in a short period of time, 90 days, if the crypto goes down, if Bitcoin goes down less than 20%, you lose zero. So it's down 10, 50. Let's say you put 100 in. Let's use real numbers. $100,000 in. Crypto, Bitcoin drops 10%. At the end of 90 days, what do you have? 100,000. The next 90 days, you re-up. It goes down another 20%. Another 10%. What do you have? 100,000. It does that for 4 quarters in a row. Bitcoin is down 40%. You've lost zero. What if it goes up? Correct me if I'm wrong. 80% of the gain. Nobody's correcting me, so I guess I'm right. Bottom line is, if it goes up from 100 to 140, the 40 you get 80% of, you got $1.32. and you lock that in at the end of the 90 days. Now it resets. If it goes down 20% off the 132, you're protected down 20%. And if it goes up, you get 80% of the gain. It is a fascinating investment tool. And I'm trying to read the audience. I'm usually pretty good at this. And I'm thinking they're thinking poo-poo caca. That's what I'm thinking. Hard to argue with poo-poo caca. That's a highly technical term used by the most sophisticated financial experts in the country. Mostly me, but other people, I'm sure. I agree. It's not a venture for most people. And fortunately, ETFs are available. You can put 50 bucks in. So if you're saying, I just don't want to be left out, put $1,000 in it, let it ride. Maybe you'll have 1,100 bucks. Wouldn't that be great? Folks, we've covered a lot of questions. As I turn back to our audience listening in from home, if you get a sense that you've missed something, you've missed something. This audience is fantastic. We've filled the room. We've got a tremendous team and lots of folks who have asked very, very interesting questions. And gosh, I'm sure you've learned a great deal. I'm sure I've learned a great deal. And I've also learned that I better not quit my day job because the whole humor thing, probably not in my future. But maybe for you, you found something that was either amusing, entertaining, or hopefully informative, hopefully answered a question that you may have had, or may have sparked a series of questions that you're going, I'm trying to put all of those together. And those are the emails that we like. To be fair, we like those the most. Because there's tremendous amounts of interaction between all facets of a person's financial life. You don't invest without worrying about taxes. You don't do your estate planning without worrying about insurance. You don't do insurance without worrying about cash flow. All of these things fit together. And that's why your questions are the most interesting to us, because you ask them about what's important to you. You've made us very, very relevant, and we're deeply appreciative. If you've learned enough or maybe smiled a bit and are willing, we will be returning next week with another edition right here behind this platform. Another edition for you of More Than Money. Good night.